We really need to talk about the divorce today.
Oh yeah, it's messy, it's expensive, and honestly, frankly, it's about time.
Welcome back to Talk Tickers. We strip the fluff, we track the tickers, and we tell you what the street is actually thinking. And today we are doing a deep dive into a breakup that is going to entirely reshape the beverage sector.
Right.
We aren't just recapping a press release for you here. We are getting into the actual plumbing of this split. I'm your host, and across the desk is our resident market analyst. You look like you've had way too much caffeine this morning.
I am running on pure Robusta today, I won't lie.
I can tell.
And it's fitting, right? Because we are looking at KDP today, Keurig Dr. Pepper.
Ticker KDP. It is Wednesday, February 25th, 2026. And if you haven't pulled up your terminal yet today, you missed quite a show yesterday. We're covering the Q4 2025 earnings call, which, well, it hit pre-market yesterday morning, Tuesday, Feb 24th.
And if you just glanced at the headline number on your phone, you'd probably think, business as usual, nothing to see here.
Exactly.
But the price action, that tells a totally different story. The stock closed at $31.03. That is a plus 4.23% candle on the day.
Which, I mean, for a boring consumer staple that sells soda and coffee pods, a 4% move is like a high beta tech stock moving 20%.
It really is.
That's a massive, massive repricing.
It is. And the volume absolutely confirms it. We saw over 19.2 million shares trade hands yesterday.
Wow.
Yeah, the daily average is usually right around 5.5 million. So this wasn't retail day traders playing around. This was institutional rotation. The big money was moving.
But here's the thing that really confused me when I was looking at the source material. I look at the guidance for Q1 2026, and it looks terrible.
It's ugly.
We have leverage issues with the JDE Peets acquisition. We have coffee costs just absolutely blowing out the margins.
Yeah.
Yet the market is buying this thing hand over fist. Why are they ignoring the fire in the kitchen?
Because they aren't buying the kitchen.
Yeah.
They're buying the brand new house next door that KDP is building. The market is looking past the whole sum of the parts valuation model and focusing entirely on the separation. They want the refreshment business. And they are willing to hold their nose through all this coffee volatility just to get it.
All right, let's back up and really frame this for you, the listener.
Yeah.
Because this isn't just about whether they sold enough soda last quarter. This is a fundamental restructuring of a massive conglomerate. We have a real tale of two cities situation going on here.
That's the perfect analogy. On one side, you have the best of times. That's the U.S. refreshment business. It's booming, it's agile, it's stealing market share.
Right.
And on the other side, you have the worst of times. The U.S. coffee business. It's grinding, it's inflationary, and it's shrinking.
And management is finally admitting that these two cities shouldn't even be on the same map anymore. So today we are going to break this deep dive into 4 distinct acts. We'll start with the headline beat to see what actually happened yesterday morning. Then we are going deep into the Refreshment Alpha, because I really want to know why a 100-year-old soda brand is suddenly the coolest thing on TikTok.
That is a fascinating case study in itself. But then we have to take our medicine and look at the coffee headwind. We need to explain why your K-Cups are about to get more expensive and why KDP is taking a huge hit on it right now.
And we'll wrap up with the financial engineering, the absolute origami behind the JDE deal financing and that kitchen sink guidance for 2026. And of course, stick around for the end because we have a trade pitch for you that is, well, it's aggressive.
Aggressive is definitely a polite way to put it.
Let's start with the results snapshot. Walk me through the print.
Okay, so headline numbers first. Adjusted ZPS earnings per share delivered 60 cents. The street consensus was sitting at 59 cents.
A 1-cent beat. Stop the presses.
Right. I mean, a penny beat usually gets a yawn from the street. It's a 1.7% year-over-year increase. If that was the whole story, the stock would have just traded flat. But the real story, the actual signal in all this noise, was the top line. Revenue came in at $4.5 billion.
Against an expectation of what?
$4.36 billion.
Okay.
So that is a significant, undeniable beat on revenue, up 10.5% year over year.
Hold on a second. Double-digit revenue growth for a consumer staple.
Yeah.
In this specific macro economy.
That is the massive outlier here. Most staples right now are fighting tooth and nail for 3 or 4% growth, and mostly they're just getting that through price hikes.
Exactly.
KDP is putting up double digits. That tells you there is real underlying volume momentum. It's not just inflation pricing masking flat volume. People are actually buying more of the product.
So the market sees that top line number yesterday and thinks, okay, the engine is actually running hot.
Exactly. But it wasn't an immediate reaction. Pre-market trading was actually pretty flat, maybe up a fraction. It took a few hours for the sell-side analysts to really digest the transcript and pull apart the segments. Once they realized exactly where that growth was coming from, the buy orders just started flooding the tape.
Because they realized it wasn't the coffee.
Oh, it definitely wasn't the coffee. The narrative shifted in real time yesterday from, Keurig is a struggling coffee company to this realization that this is actually a refreshment beverage powerhouse with a massive M&A turbocharger attached to it.
Which brings us to the real star of the show.
Yeah.
Let's get into Deep Dive Part 1. U.S. refreshment beverages. This is the alpha. This is that house next door you mentioned earlier.
This segment is doing all the heavy lifting for the entire enterprise right now. U.S. refreshment beverages, or USRB for short. Net sales were up a staggering 11.5%.
11.5%. I was going to pause on that for you guys listening. That is a massive number in this space.
It's enormous. And operating income was up high single digits, too. So this isn't empty calories where they're just buying revenue with heavy discounting. It's highly profitable growth. And it's driven by a strategy that really seems to be firing on every single cylinder right now.
It's funny, because for years, the Dr. Pepper part of Keurig Dr. Pepper just felt like the boring cash cow. Just keep the soda on the shelves, collect the steady checks, and let the coffee tech drive the sexy growth. But the script has completely flipped.
Totally flipped. Dr. Pepper is the growth engine now. Let's look at the core brand first. Dr. Pepper gained market share for the 9th consecutive year.
9 years. I mean, think about that. That spans completely different macro economies, different diet trends, the whole rise of sparkling water.
Right.
And they're still gaining share. How are they doing that? Is it just that people really like the taste of 23 flavors that much?
Taste definitely helps, but you don't win for 9 straight years on flavor alone. It's what management likes to call their marketing alpha. They have essentially mastered the art of culture jacking.
Explain culture jacking.
It means they don't just run traditional ads. They aggressively insert the brand into whatever the current cultural conversation is. We all know about Fansville, right?
Oh, yeah. The episodic drama they run during college football season.
Yeah.
The one where the sheriff investigates people for drinking generic soda or whatever. It's campy, but people genuinely love it.
It keeps the core base engaged and loyal. But that's still traditional TV marketing at the end of the day. What they did in Q4 was pure digital agility.
Did you see the Dr. Pepper baby trend on TikTok?
I think my niece actually sent it to me a few months ago. It was that weird, super catchy jingle, Dr. Pepper baby, it's good and nice, something like that.
That's the one. It started as a completely random user-generated video, literally just a grandma singing to her grandkid about soda, and it went insanely viral. Now, usually a big corporate marketing department sees something like that, they call a massive committee meeting.
They call legal.
They absolutely call legal. They do a 6-week focus group, and then half a year later, they put out a highly sanitized tweet. And by then, the meme is completely dead.
Right. It's the classic, how do you do fellow kids meme.
Exactly. But KDP didn't do that. They saw the heat on this video. They immediately contacted the creator, licensed the audio, and turned it into a national championship ad spot within a matter of weeks. That is incredibly fast. That is startup speed, not Fortune 500 consumer packaged goods speed.
And that speed matters to Wall Street. It tells investors that the management team is actually awake at the wheel. They aren't just managing a slow decline, they are aggressively hunting for consumer attention. And as the Q4 numbers show, that attention directly translates to sales.
But marketing is only half the battle, right?
Yeah.
You can have the best, most viral ad in the world, but if the actual bottle isn't sitting on the shelf when I walk into my local 7-Eleven, you lose the sale.
Which brings us to their massive operational win this quarter. Distribution. They successfully transitioned the Dr. Pepper brand distribution over to their own DSD network in California, Nevada, and the Midwest.
Okay, we throw the acronym DSD around a lot in this industry, direct store delivery. For the listener who isn't actively studying supply chain logistics or stocking shelves at Kroger, explain why DSD is such a weapon compared to the traditional alternative.
The alternative is what's called warehouse direct. That means you put your cases of soda on a giant pallet, you ship it to the massive Walmart regional distribution center, and you wave goodbye.
Hope for the best.
Exactly. You are relying entirely on the Walmart employees to unpack it, bring it out to the retail floor, and actually stock it.
And maybe they do it today, maybe they don't. Maybe you end up shoved on the bottom shelf behind a structural pillar where nobody can see you.
You have zero control over the final mile. DSD is a completely different ballgame. With direct store delivery, your guy drives the truck. Your guy walks into the convenience store with a dolly.
Right.
Your guy personally fights the store manager for the eye-level shelf space. He physically builds the cardboard end cap display for the Super Bowl promo, and he makes absolutely sure the cold vault is fully stocked, faced, and looking perfect.
It's essentially shelf warfare.
It is hand-to-hand combat for retail real estate. And by moving Dr. Pepper into their own captive DSD network in those specific Western and Midwestern regions, they took total control of their own destiny. They aren't relying on a third-party distributor anymore.
And doing that without totally disrupting existing service is a massive logistical feat in itself.
A huge feat.
So they have the marketing alpha dialed in, they have the distribution control locked down. Now let's talk about the actual payload. What else are they putting on these trucks? Because it's clearly not just Dr. Pepper anymore.
No, this is the growth vector part of the bullish thesis. It's energy and hydration. And the absolute superstar in this portfolio right now is Ghost.
Ghost Energy. The cans with the textured labels that look like street graffiti art.
That's the one. The integration of Ghost was highlighted on the call as major, major success. Remember, KDP initially bought a huge stake in this brand, and they are in the process of fully acquiring it. They plugged Ghost straight into that DSD network we just talked about, and sales just exploded because suddenly Ghost is available everywhere all at once.
But they aren't just taking the existing cans and scaling them. They're actively changing the form factor. I saw a really interesting note in the source material about new 8.4-ounce cans.
Yes, this is a direct, calculated, strategic dagger aimed right at Red Bull.
How so? Walk me through the psychology of the can size.
Think about the consumption occasions for energy drinks. Ghost, Monster, Reign, they are traditionally sold in 16-ounce tallboy cans. That's a gym drink. It's a marathon gaming drink. It's a lot of highly caffeinated liquid.
Yeah, I'm definitely not chugging 16 ounces of Ghost right before a 9 a.m. status meeting.
Exactly. You'd be vibrating through the walls. But the 8.4-ounce can, that's the classic Red Bull size. That's the morning commuter size. That's the quick afternoon pick-me-up size.
Interesting.
By launching Ghost in 8.4-ounce formats, KDP is basically telling consumers, hey, you can drink this on your way to work just like your coffee. It effectively doubles their total addressable market and puts them directly head-to-head with the undisputed market leader in that specific daily occasion.
That is incredibly smart. It's not just rolling out more flavors, it's capturing entirely new moments of the consumer's day.
And it's not just Ghost doing the work either. The entire partner brand portfolio is just clicking right now. Brands like C4, Bloom, Black Rifle Coffee, they are all significantly outperforming the broader energy and coffee categories.
Bloom is a really interesting one to me. That's the viral greens and wellness brand.
Correct. And it brings a totally different demographic into the KDP portfolio. It skews much more female, much more holistic wellness focus than a brand like C4 or Monster ever could.
And what about the hydration side?
Electrolyte is crushing it. It was actually the single largest share gainer in the entire sports hydration category in Q4. And then you have Vita Coco, which grew its retail sales by over 20%.
So pull all of this together for me. If I'm an investor looking at the refreshment side of this business, what is the ultimate?
Whoa, what here? So what is that KDP has definitively proven they have built a plug-and-play machine. They have built an incredibly valuable distribution highway, the trucks, the regional routes, the premium shelf space.
Right.
Now they can just go out, find a hot, trending brand like Ghost or Electrolyte, plug it straight into that highway, and instantly scale it to billions of dollars in revenue. That build-by-partner model is the entire fundamental thesis for holding the future Beverage Co. after the split.
You're essentially buying a distribution platform, not just a static product lineup.
Precisely. You're buying the pipes.
All right. Well, that was the fun part. That was the champagne and confetti. And now we really have to look at the hangover. Let's get into deep dive part 2, U.S. coffee. The headwind.
Yeah, the music abruptly stops right here. This is the ugly part of the print. There is absolutely no way to sugarcoat these numbers.
Let's look at them. Coffee sales were up 3.9%, which on the surface doesn't sound apocalyptic.
Don't be fooled by that top-line number. That growth is purely due to cyclical pricing actions. They raise prices on the consumer, so the revenue looks okay on paper. It is not volume growth.
Because When we look down at operating income,
Down 8.8%.
and the metric that honestly scares me the most in this entire document, brewer shipments,
Down 16.8%.
that is an absolute collapse. Almost 17% fewer machines sold into the market. That feels like a deep structural problem to me.
It definitely suggests two very concerning things. One is simple market saturation. Everyone in America who actually wants a Keurig machine probably already has one sitting on their counter. There are only so many kitchen counters in the country.
Fair point.
And two, it shows severe consumer pullback. When household budgets get tight, you delay replacing your slightly leaky coffee maker. You just put a paper towel under it and make it work for another year.
And the razor and blade business model dictates that if you aren't selling the razors, eventually you're going to stop selling the blades, or the K-cup pods in this specific case.
Exactly. The total install base is under intense pressure, but the immediate acute pain, the reason operating income is down almost 9% right now is pure inflation. Management heavily flagged green coffee cost inflation and severe tariff pressure on the call.
Now, we've been reading about coffee commodity prices, both Robusta and Arabica, hitting record highs for months now. Why is it only hitting KDP's margins right now in early 2026?
This is the lag effect. And this is so crucial to understand if you are analyzing commodities. Massive companies like KDP don't buy their coffee at the spot price you see on the news today. They hedge.
Right.
They buy complex futures contracts 6 to 9 months out to lock in their prices and stabilize their supply chain.
So they're basically buying insurance on the future price of beans.
Right. But that conveyor belt of inventory keeps moving. The coffee beans they are physically grinding, packaging, and selling today in Q1 of 2026, that batch was priced and locked in 9 months ago, exactly when the commodities market was violently spiking.
Oh, I see. So the historically high prices from last year are only just finally flowing through the actual P&L.
They are hitting the cost of goods sold line right now. Even if global spot prices crashed to zero today, KDP would still be forced to eat those aggressively high costs for another 2 quarters. It's like watching a snake digest a bowling ball.
That's a great visual.
You can see the massive lump slowly moving through the digestive system, and right now, that lump is sitting squarely in their Q1 2026 margins.
And on top of all that input cost pressure, retailers are also destocking their shelves.
Yes, which is a double whammy. Retailers like Target and grocery chains are looking at the weakened consumer, seeing the slow sell-through, and saying, hey, we really don't want to hold 3 months of expensive coffee inventory on our books right now. Let's hold 1 month.
So they order less from KDP, which directly hurts KDP's sell-in volume numbers.
Exactly. So you have a totally saturated machine market, historically high unhedged input costs coming due, and your biggest retail partners pulling back on orders.
So what is the fix here? Because you can't just keep raising prices on K-cups to protect the margin forever. Eventually, the consumer breaks and just goes back to a standard $10 Mr. Coffee drip machine.
The only real fix is innovation. And management is betting the absolute farm on 2 big, very expensive initiatives. First is Keurig Alta.
We've heard some industry whispers about Alta for a while now. This is the big iPhone moment they've been promising Wall Street.
That's certainly the internal hope. Beta testing on the new hardware is officially complete. They are targeting a late 2026 commercial launch. Alta is designed to be a true master system. It does high-pressure authentic espresso. It does your regular daily coffee. It utilizes entirely new, different pod form factors. It's a highly premium experience specifically designed to force people to finally upgrade their old, dusty machines.
So it's a forced upgrade cycle. They desperately need to turn that aging install base over to generate new hardware revenue.
Exactly. And the second big bet is something called the Keurig Coffee Collective. This is fascinating. They're trying to take the Keurig brand, which has near universal household awareness, and aggressively move it out of the appliance aisle and into the bagged coffee aisle.
Wait, so actually selling whole beans and ground coffee in standard bags, but branded as Keurig?
Yes. Not the proprietary machine tech, just the actual roasted coffee itself. It's a strategic move to finally capture the millions of consumers who fundamentally refuse to use a pod machine.
That feels, I don't know, that feels incredibly risky to me. Does the brand name Keurig genuinely mean great tasting coffee to the average consumer, or does it just mean convenient, fast coffee?
That is the multi-million-dollar question that Alta and the Collective are going to have to answer. But here is the hard reality check for you listening today. Investors have to be incredibly patient here. The coffee turnaround is a 2027 story.
It is not a Q1 2026 story.
Not at all. The Alta launch doesn't happen until late this year. The input costs are brutally high right now. You are holding the coffee side of this business purely for the cash flow it generates, not for the top line growth. At least not anytime soon.
Okay, let's take a very quick detour before we get to the massive structural deal. Let's look at Deep Dive Part 3, International Performance.
The international segment was actually a really bright spot, statistically speaking. Sales were up 21% on a reported basis. Operating income was up 20%.
But I can hear a massive but coming from across the table.
There is always a but in these regional reports. There is a huge anomaly in the Mexico numbers. Management specifically flagged heavy buy-ahead activity in that market.
Explain buy-ahead for us.
A very significant new beverage tax increase officially kicked in down in Mexico on January 1st, 2026.
Ah, okay. The classic sin tax on sugary drinks.
Right. So put yourself in the shoes of a major retailer in Mexico City. What do you do in November and December of 2025?
You buy as much Dr. Pepper, Peñafiel, or whatever else you can possibly fit in your backroom warehouse at the old, much lower tax rate.
You front-load your entire Q1 inventory. Exactly. So KDP's Q4 sales figures looked absolutely amazing on paper because everyone south of the border was aggressively hoarding stock. But the obvious implication is a massive hangover.
Right.
Expect a very, very soft start in the international segment for Q1 2026 as all that hoarded inventory slowly bleeds off. Those retailers won't order a single new bottle from KDP until they completely sell through their tax-free stockpile.
So the takeaway for the listener is, do not extrapolate that 21% growth rate forward. It was a one-time regulatory sugar high.
Correct. Do not model that into your spreadsheets.
Okay, now we finally get to the main event, the mechanics of the divorce. Let's get into Deep Dive Part 4, the JDE Peets acquisition and the resulting split.
This is the ultimate catalyst. This is the entire reason the stock is moving the way it is. The latest deal update is that the closing target for the JDE acquisition is now early April 2026. We are literally weeks away.
And the promised endgame is the full separation of the company.
Yes. By the very end of 2026, if everything goes to plan, we will have two distinct publicly traded companies. Beverage Co, which will house the U.S. refreshment and soda business, and Global Coffee Co, which takes the legacy Keurig business and combines it with the newly acquired JDE Peets assets.
But as we all know, it costs a whole lot of money to get divorced. Let's talk about the specific capital structure here, because they substantially changed the financing plan yesterday.
They did. They had to get incredibly creative to keep the credit rating agencies from downgrading their debt. They are taking on an absolute mountain of new debt to pull this off, and they desperately needed to cushion the blow to the balance sheet. So they introduced something called the Pod Manufacturing JV.
A joint venture. It sounds like pure Wall Street financial origami. What exactly is it?
It is absolute origami. They are taking their own captive manufacturing factories, the literal brick and mortar buildings, and the proprietary machines that stamp out the K-Cups, and they are selling a large stake in those physical assets to a private partner for $4 billion in cold, hard cash.
So they are effectively selling the kitchen appliances to pay for the divorce lawyers.
Essentially, yes. It's a clever way to unlock the trapped enterprise value of the concrete and steel to get $4 billion in cash onto the balance sheet today without actually losing operational control of the supply chain.
Wow. And then there's the convertible preferred equity piece.
Right. They upsized this specific tranche to $4.5 billion. And this move is highly controversial among institutional holders.
Why are they mad about it?
Because convertible always implies future dilution. These are special preferred shares that pay a fixed dividend now, but the holders have the right to convert them into regular common stock later on.
Oh, I see.
If the KDP stock price rips higher after the split, these institutional investors will absolutely convert those shares, and suddenly the total equity pie gets cut into millions of more slices. The existing retail shareholders get their ownership heavily diluted.
So if it angers the existing shareholders, why do it? Why not just issue standard bonds?
Because the rating agencies treat convertible preferreds partially as equity, not pure debt. It artificially suppresses their leverage ratios and protects that crucial investment-grade credit rating. And speaking of the actual debt, they are officially issuing $9 billion in brand new debt, and they are also legally assuming $5 billion of JDE's old existing debt.
That is $14 billion in total debt obligations being shuffled around in what is still a relatively high interest rate environment. That makes me incredibly nervous as an investor.
It creates a staggering amount of leverage. And honestly, that was the primary bear case floating around Wall Street going into this earnings call yesterday. The market was absolutely terrified of that leverage ratio.
But the management team clearly has a rebuttal prepared for that fear.
The rebuttal is one simple phrase: free cash flow. That is the only reason the math on this massive deal actually works. Standalone KDP free cash flow is conservatively projected at roughly $2 billion for 2026. And then JDE adds another massive chunk of cash on top of that. Coffee, for all of its terrible top-line growth faults right now, is an absolute cash cow.
It's Prince money.
It requires very little ongoing capital expenditure compared to other heavy industries. So management's stated plan is swift deleveraging. They're going to take that massive fire hose of combined coffee cash flow and aggressively pay down the principal on that $14 billion in debt over the first 18 months post-close.
So the grand thesis here is use the boring coffee money to violently clean up the combined balance sheet and then spin off Beverage Co. as a pristine, unburdened, high-growth asset.
Exactly. You load all the heavy debt onto the mature entity that actually has the reliable cash flow to service it, and you free up the agile growth entity to just fly.
Which perfectly brings us to the broader investor context, the actual 2026 guidance. Because this is where management played a masterful game of kitchen sink.
They absolutely did. They gave the market a very shiny carrot and a very heavy stick. The carrot is the full-year guide. They're projecting net sales between $25.9 and $26.4 billion for the year, and crucially, low double-digit adjusted EPS growth.
That sounds fantastic on the surface.
It does, but then they immediately took out the stick. The Q1 specific warning.
How bad is the Q1 stick?
The Q1 EPS guide is a measly 36 to 37 cents. Remember, in Q1 of last year, they did 42 cents. That is a massive, highly visible drop year over year.
Why such a severe drop specifically in this current quarter?
It's a perfect storm of three distinct headwinds hitting the P&L all at exactly the same time. First, they are lapping a very large one-time cocoa commodity gain from last year. Basically, they had a lucky financial hedge that paid out, and that obviously won't repeat this year.
Right.
Second, that peak coffee cost inflation we broke down earlier, that 6 to 9 month lag is ending, and those historically high costs are hitting the exact margins right now. And third, the retailer inventory destocking adjustments we talked about.
But despite all of that very real, quantifiable bad news, the market just shrugged it off. The stock went up over 4%. Why?
Because of how Wall Street is interpreting the psychology of the guide, the market sees this as management actively kitchen sinking the first quarter.
For the newer listeners, explain exactly what a kitchen sink quarter is.
It's a classic corporate maneuver where a new or transitioning management team throws every single possible piece of bad news, every write-down, every macro headwind into one single quarter just to get it entirely over with.
Right. Get all the trash out of the house at once.
Exactly. They are intentionally setting the performance bar for Q1 so incredibly low that they can easily step right over it when they report in May. They are aggressively clearing the decks before the JDE deal officially closes in April.
So it's a complete baseline reset.
It's a massive psychological reset.
Yeah.
And mathematically, it heavily implies a hockey stick recovery later in the year. If Q1 is definitively the fundamental bottom and the mega deal closes in Q2, then the entire second half of 2026 is going to look mathematically spectacular by comparison. Institutional investors are actively betting on the steep slope of that back half recovery line.
All right, I think we've had enough of the balance sheet forensics for one day. Let's actually try to make some money off this mess. It's time for the segment we legally have to call This Is Not Financial Advice.
Oh, I've been waiting for this one all morning.
This is the part of the deep dive where we pitch an outrageous but plausible trade structure. Like we're sitting in a glass conference room trying to get a stubborn portfolio manager to sign off on a $50 million line. It is high risk, it is high concept, and it carries absolutely zero liability for us. What are you bringing to the table today?
I am calling this specific setup the caffeine divorce arbitrage.
That sounds incredibly messy. I like it. What's the angle?
Here is the stark reality of the board right now. The broader market is currently valuing KDP with a massive conglomerate discount. It's trading weirdly cheaply because the stagnant coffee business is dragging the entire enterprise multiple down like a lead anchor.
Right.
But the planned split later this year definitively cuts that anchor loose.
So the obvious play is to just get long KDP before they cut the rope.
That is step one, long KDP equity. You buy the common stock today to capture the inevitable multiple expansion run-up as we approach the Q4 split date. You desperately want that standalone Beverage Co stock in your portfolio. You want to own the Dr. Pepper and Ghost distribution machine before the street re-rates it to a premium monster beverage-style multiple.
But hold on a second. You literally just spent the last 10 minutes telling me that Q1 is going to be an absolute disaster because of peaking coffee commodity prices squeezing their margins.
I do.
So if I buy the stock right now, today, and coffee spikes again next week, I'm going to get completely crushed when they report in April.
That is the exact systemic risk, and that is exactly why step 2 is the critical hedge. You immediately short green coffee futures on the commodities exchange. Or, if you don't have a futures account, you buy a specialized ETN that shorts the underlying coffee commodity index.
Oh, wow. So you're actively playing both sides of the P&L.
You absolutely have to. Think about the mechanics of their income statement. What is the single biggest fundamental risk that kills KDP's earnings in the first half of this year?
It's those high unhedged coffee prices totally squeezing their operating margins.
Exactly. So if global coffee prices scream higher over the next 3 months, your long KDP stock position might take a severe hit because the global Coffee Co segment looks structurally terrible to Wall Street. But your short position on the coffee future...
And that trade is going to print money.
It prints money. It perfectly offsets the unrealized loss on the KDP equity. You're completely immunized against the commodity shock.
And what if the opposite happens? What if the Brazilian harvest is amazing and coffee prices completely crash tomorrow?
Then your short futures hedge obviously loses money. But guess what happens to KDP's internal margins when input coffee gets cheap?
They explode upward.
They explode. The earnings beat expectations and the underlying stock rips higher. So you lose a little on the commodity hedge, but you win massively on the equity re-rating.
You're isolating the true catalyst here. You're surgically stripping out the volatile commodity risk so you can safely own the long-term operational execution story.
Precisely. And then comes step 3, the exit. The exact day the corporate spinoff actually happens in late 2026, you hold on to all your newly issued shares of Beverage Co. because that's your pristine Dr. Pepper and Ghost growth engine.
Yep.
And you immediately, without hesitation, dump every single share of Global Coffee Co. onto the open market.
That is brutal. Just flush it entirely.
It's purely business. You don't want the commodity exposure long term. By doing this, you are effectively synthesizing a discounted pre-IPO entry into one of the fastest growing beverage platforms in the world while entirely bypassing the sluggish, volatile commodity trader that currently happens to be legally attached to it.
That is incredibly sharp. It's complex. It's definitely a little dangerous for a retail account, but it is conceptually razor sharp. And as always, listener, you know the drill.
That was definitively legally not financial advice.
Please do your own diligence before trading commodities. We're just two voices on a deep dive, sitting here trying to figure out if we should switch our morning routines to green tea.
Speak for yourself. I am strictly sticking with the double espresso.
Fair enough. So let's quickly recap the entire board for today. KDP delivered a very solid Q4 beat on the top line. The U.S. Refreshment segment is absolutely on fire thanks to the Ghost integration and masterful Dr. Pepper digital marketing.
Meanwhile, the coffee segment is sitting in the penalty box dealing with historically high input costs and heavily shrinking hardware volume. But management does have a viable hardware innovation roadmap with Alta.
The massive JDE acquisition deal officially closes in April, and the combined conglomerate splits into two pure-play companies by December.
And remember the kitchen sink. Q1 is going to look incredibly ugly on paper. Don't panic when you see the headline EPS numbers cross the wire in April. The broader market is explicitly playing the long game on the end-of-year split.
The smart institutional money is buying the corporate structure. They are not buying the quarter.
Exactly right.
And that is the print for today. Be sure to check the show notes for the full structural breakdown of the convertible debt numbers we discussed. Markets close, but the numbers never sleep. We'll catch you on the next print.
See you then.